Hey guys, Scott Short here with Empire Home Loan Corporation. My MLS number is 225998, and my DRE number for California is 01074493. Long number, and here, my friend,
Tracie Panish with Partners Credit and Verification Solutions.
Boom. So what she does, her company is our arm between us and the bureau. So we want a credit report. We call Tracie's going to be do that for us or whoever lender she works with. Works a lot of people.
Partners Credit. Yep. So essentially we're the first transaction to every file.
That's true.
Mm-hmm. Yeah, that's how I like to say it.
Sometimes should be the one prior to that too.
Yeah.
Because some of the people credit, man, we gotta take ownership with credit. So if there's a problem with it, being you made the problem or they made the problem, we need to figure it up front because it's a problem.
Right, I agree. And
so
pay attention to it, so it'll get you a better rate.
Exactly.
It'll get you into a better home.
Yeah, so you get mortgage, you get the interest rate, the mortgage, the insurance rate, everything's all cry because that's your history saying to a lender you're either a good or bad payer. I mean, will you pay me back or not? If you're not gonna pay me back, I ain't lending money to you, right?
Are you risky or are you worthy?
Right.
Right?
Oh, I like that.
Yeah.
Okay, cool. So let's start with this. So we're gonna start off. There's, it's not a new word for us as lenders, but for the public, the word soft credit pull versus hard credit pull. What's that mean?
Okay, those are two different scoring models. So they are coded differently on our end or a lender's end. One is coded to be a hard pull, which will pull an inquiry on your credit report, and inquiries do impact your score very minimally, and they stay on your score for 2 years.
Cool.
Soft pulls do not. Soft pull you cannot utilize to run through bigger entities to approve your loan. It's just getting a peek at your credit. It alleviates the trigger leads, and it also does not cause that inquiry on your credit report.
So why would somebody care about that inquiry on the credit report?
Because trigger leads are out of control.
What is that? What is that?
A trigger lead is when someone pulls your credit report, like a lender such as Scott, and all of a sudden you get 50 million solicitors asking if they can get you a better deal.
So how did that happen? So basically, let's say I pull a credit report, a full-blown hard pull, right? Not a soft pull, hard pull report for a mortgage. I submit that information to it. Boom, I get my credit report back. Then pretty much within 30 seconds later that my client's getting a bunch of phone calls. How's this happen?
So that's another revenue stream for a lot of companies out there. They're able to create these lead lists, and lenders will purchase those. With the market being so tough right now and the rates being higher than we're used to, a lot of people are purchasing those leads. So trigger leads are on the rise, and trigger leads are a problem. We are starting to see a lot more folks pull soft pulls on the front end. If a borrower doesn't know where their credit score stands, they're typically directed by someone like yourself to go pull a soft pull through you, or to go to annualcreditreport.com.
Now, when you say somebody sells it, it's not the lender selling it, it's the credit bureau selling information to people, correct? Okay, so when you say credit bureaus, that means Equifax, Sprint, and TransUnion. That's our three major players. Okay, so when they sell that information off, anybody buys it, they blow your phone up. It could be 50 phone calls or more. Some of these people are not very even truthful when they call you. Say, "Oh, I'm part of your lender. I need some more information from your lender." That's not your lender. That's some other fool from God knows where. So be super careful.
Super careful. And let's talk about how
break it down.
You can alleviate that. So
or minimize it.
Minimize it. Minimize it. Because you can't truly alleviate anything,
wish I could.
Right? So annualcreditreport.com, you can go and, not annualcreditreport.com, optoutprescreen.com.
It's okay. Annual's where you get the free credit report.
Annual's where you get your free credit report. Optoutprescreen.com is where you can opt out of getting those leads. Although it does take time,
How many days?
5 days, but I would honestly give yourself 10.
Right.
10 for it to take place and opt you out of getting any of those solicitations.
Right. Now, I was thinking, I told Tracie we were talking about this also, is that if you'll be super careful, you actually can go to Federal Trade Commission, FTC.gov, add your name and all your every phone number you have, add it to the do not call list. Because the penalty on do not call list is pretty hefty, I think.
Right.
If somebody calls you and you're on do not call list, just take that phone number down and good job. But so back to this. So if you go to optoutprescreen.com, I also heard this, and I don't know if you know this. I heard this in the past that if you did that, it stops them selling your information to the trigger lead people. Also heard that a lot of that credit card solicitation, you get the little preview stuff that stops that too. Do you know if that's true or not? Okay, cool.
You'll notice your mail
shrinkage.
Will
I like
go
that.
down.
I like that.
Solicitation in your mailbox will go down a little bit. So
it
has its benefits.
I recycle it up.
Yeah, exactly.
Like,
save a tree.
So optoutprescreen.com. Do at least 10 days prior to having the lender run your credit. If lender doesn't tell you about this stuff, slap them, because they should tell you this stuff. Because
Well, then call Scott.
there you go. I appreciate it. Thank you. That's a paid endorsement. Just kidding. Just kidding. So also we want to talk about on the same conversation. Let's go to I hate this, people. You know me. I hate Instagrams, myths, and garbage. There's a lot of garbage out there. Clickbait, trash, garbage. I ain't saying the other word because it's just not good. Clean word. So let's go this way. You had some myths and some things you want to talk about. Let's talk about that real quick.
Yeah, so let's talk about what's included in your credit score.
Okay.
What constitutes and how does that happen? How do you get a credit score? So the number one thing that these scoring models look at is your on-time payment history. That's 35%. Okay. That's the largest percentage. So you always want to pay your bills on time.
So define on time.
On time is less than 30 days.
So let's say if I paid, let's say I paid August 25th. Then do I need to pay before September 25th, or I have to look at the bill? It says
look at the bill and paying it when it says it's
due. So but when you say due, does that mean I got seen you go online and pay by? I seen your check that day, or the check has to be in your account that day?
It depends. It's up to you. Anything past that due date, you could initially receive a late fee. So you definitely, my thought process would be.
Plus, I'm thinking that if you didn't pay on time, let's say you send a check on days due, right, and then the check gets the next day. When they report the bureaus, the balance is going to be prior to the pay because they already reported. Is that kind of your understanding?
Yes. So there's different. They submit the tapes for all their reporting. So I would definitely pay it before the due date if you can.
Yep.
If not, you could incur a late fee, but never ever go past that 30-day window.
So let's make sure. So on the 30-day window, it's going to be, if it says it's due on this date here, you got 30 days from that due date to the next month.
Yes,
right? Okay, good.
Until it hits as a 30-day, and it will show up on your credit report and stay on there for 7 years.
Not 2 years.
Not 2 years. 7 years plus 180 days from your initial missed payment. And that weighs heavy. So 35%, pay your bills on time. Any questions, call Scott.
That's right. And if you're a lender, call Tracie.
Yeah, if you're a lender, call me. The next thing is utilization. So what is utilization? So it's your balance to credit limit ratio.
Okay.
So your best point of return on your FICO score would be anywhere from 10 to 30%.
Okay.
So if you have a $500 credit limit, you don't want to max that out every month. That's going to hit you a 30% ding on your credit report.
Right.
So that's the second worst thing that you could do to your credit score is to charge up those credit cards and only make those minimum payments. Keep it down to a 10% utilization level.
So you're saying on $500 you went $50 max, right?
Yeah.
Okay, good.
That's where you're going to get your best return.
Right. Okay. For scores.
For scores, but keep in mind, scoring models, the Equifax, Experian, TransUnion, they all have their separate models.
Right.
They all are different scoring cards behind the scene.
Okay.
We can get into that, but we don't want to go that here.
Right.
So everything's going to weigh a little bit different for each individual.
Okay.
Everything's not the exact same for everybody out there because you all have different things going on.
Right. Okay, cool. What's your next one? What's your next topic?
History.
Okay.
So they want to see that you are a responsible person, paying your bills on time and keeping.
I got your credit card yesterday. It doesn't help.
No, not really. They can't see your history.
So let's say if
they want to see how good standing debt.
So if I got a credit card yesterday, from what I'm hearing, you've got to help me on this. It takes like 3 to 6 months before it actually starts hitting the credit report for reporting that it's going to say you have a card or not have a card. I mean, an inquiry will pop up, but that hurts, right? Because it's inquired and it's outside the mortgage industry and blah blah. That's another topic. But so I would say if you got a new credit card, you're trying to build credit, it could take a couple months for it actually hits the. It'll probably hit your credit report, but won't help your score for a while, right?
For a little while, Takes a little while. That's why do not close good standing credit revolving credit cards.
History.
Do not close those.
Right.
Just use a little bit and then pay it off.
Yep.
And just keep it active, but don't close all your credit cards and think you're going to get a good return on score because they do want to see that you can keep that credit card open and manage it.
No, have you seen where people in the past have a lot of credit cards? Is there like a number on credit cards you shouldn't have?
But I don't know. Again, it's all those algorithms behind the scene, and everybody's scoring model or scoring is different based on what they have in their individual file.
How would a lender? Sorry, what's in the topic? I'm going sidetracking a little bit. How would a lender know when they get the credit report? How do they know which FICO? What do you call it? FICO
scoring
card
model?
Yeah. How do you know that?
So with regards to, are you referring to like Credit Karma?
Well,
Or are you just
let's
talking-
say if I ran a credit report through Partners Credit Report, right? How would I know which scoring card you're using?
So there's, each bureau has their own scoring model
Okay,
that
there
they
you go. That's
built
where-
with
yeah.
FICO.
Okay, gotcha.
So Fair Isaac
Right.
Company
Right.
created the scoring model, but they created it for Equifax, TransUnion,
Okay.
and Experian,
Okay.
right?
Right.
But they're different models, and they all should be listed on that credit report
Okay, right.
that a lender
Okay.
pulls for you.
So right now, from what you know, what is the most current, up-to-date model? What people should be looking for on if they see a credit report? What you know what number it is?
It's 10.
So it's all 10. Okay, good. Okay. So everything should be.
Well, yes, and then we're also considering moving over to Vantage Score.
Yeah.
Yeah,
So
Vantage
that's another
Score.
topic. Yeah.
That's another video in itself.
That's a 2-hour video.
It's not a consideration. It's something that's going to happen.
Right. I mean, it's not going to happen today, but
No.
it's in the works. Yeah.
It's in the
Cool,
works.
okay.
Lots of things on the horizon.
So what else we got, girly?
So then, credit mix. They want to see in your
Like mix and mingle?
Yeah, mix and mingle. They want to see that you could do a good credit mix. So
Okay.
you could get a car, you could pay your evolving credit cards on time, you're responsible for a mortgage.
Right.
You're going to get the best return on your score if you're able to manage all the different types of credit
Okay.
and creating a mix.
So what would you say, and this has always been my philosophy, and help me because you like clean me up a little bit. So I've always said, credit card first, then car, and then the house. When you get that transition up, higher, as you go up the ladder, your score's gonna get better because that's a better mix.
It's weighing heavier on
Yeah.
your score. Well, you think about it, if you're buying a house, that's a lot more expensive than a car. And
Right.
if you're managing that much debt,
Right.
it's gonna help
Better. Cool. So just tell consumers, you get your credit card, get that online, get it all set up. Now, when you get a credit card, does it matter if it's a secured card versus just a non-secured credit
It
card?
depends if the bank for the secured card is reporting into the bureaus.
Okay. Well, no, would they report it as a secured card? Is that a negative effect, or just going to show us a credit card?
It's just going to show as a credit
Cool,
card.
Good.
Yeah.
Cool. I like that. So what else you got?
And then the last piece, so there's 5 pieces to the puzzle for your credits. We talked about late payments being the highest, utilization, how much you're spending on those credit cards, your credit history, how long you're keeping those in good standing, your mix, and then the last is your inquiries. So that's inquiries when you go to a department store and they ask you to open up a credit card.
Oh, you're 10% off.
Yeah, I'll give you 10%, 20% off if you open up your credit card today. Just know that inquiry, that new credit card is going to impact your score. The smallest amount.
Right.
It's typically around 10%.
Ouch.
But still, it does have an impact, and it stays as an inquiry on your credit report for 2 years.
Wowza.
Yeah, so keep that in mind.
Right?
Yeah.
So that's what I tell people when they ask me, "Well, get our credit card." I said, "I'm on the Jeannie Craig credit card diet. No, thank you." Because that's like you're saying, because it gets that in that mentality of the new credit card for a lender. That's horrible because you got new debt. I don't know what clue about it. I have no clue what's good, bad, or indifferent. So don't do that. You're in the middle of mortgage process. Do not start any credit. Do not, just freeze. I take a picture of you today. I want the same picture when we finish.
Yeah, it all impacts your score, so be careful what you do when you're getting a home loan.
So let's get our last piece here. Let's go down here, this last piece here, and we'll wrap this up. So where are we at in the last piece?
FICO models versus Credit Karma. I get a lot of loan officers that call me and say, well, my borrower said their score was better on Credit Karma. Those are different scoring models.
So how would you explain it to how should you explain to a consumer what the difference is? Yeah.
So the banks that are going to provide you with a line of credit for a home loan are using a specific scoring model, and those are the models that people like Scott will pull a hard pull credit report for you. It's going to be the hardest pull on your credit, right? Because it's the largest debt. But those are the authorized scoring models through the bureaus for the agencies, Fannie and Freddie and other top aggregators that'll buy those loans. Credit Karma, on the other hand, is a totally different scoring model. So you cannot take a Credit Karma credit report and run it through Fannie Mae or Freddie Mac to get approval. So that's the difference.
So I always tell
way
people,
heavier and lighter.
Right. So I've always told people that if you went to Credit Karma today, and you went to a car dealership today, and you also went to me today, pretty much everybody's score will be different.
Yes.
Because
different scoring models. So the auto lenders, they pull a different scoring model than a mortgage lender. Or getting a credit card is a totally different scoring model than your mortgage.
Right. And then let's say if you applied for a bunch of credit cards one time, that's probably not a good idea.
Probably not a good idea, but you do have a grace period. So the grace period is typically 15 days for Experian and 45 days for the other two.
So let's say this. Let's kind of, we'll wrap this up in tight. That if you go to one lender and they run your credit, then they do a hard pull. So I hope they do a soft pull. hard pull. So if you do a hard pull, how many days do I have from that hard pull to the other hard pull before it actually starts affecting my score?
15 days is what my
Okay, so you're saying,
golden
okay,
rule
15,
is,
cool,
is
15,
because
cool.
one of the bureaus.
Done play right. Okay, so that's what you have to be careful with. So when they tell you have a big window to shop in, I'd rather do a soft credit pull. You know, because soft credit pull, you know, it's usually soft pull is going to be one bureau, right, or is it two bureaus?
It depends. You have the option. As
No.
a lender, we can set you from
Right.
a credit reporting agency's perspective.
Right.
We can set you up to pull one.
Right.
We can set you up to pull two or
Okay.
all three, which is a tri-merge.
Okay, so let's go a little further down my rabbit hole. He hates when I go rabbit hole, but be careful. So rabbit hole is going to be, if I do a soft pull versus a hard pull, is the credit different?
It can be.
Okay.
It can be.
Okay, so it can be.
Depends on what you're pulling it for.
Right. So let's say if I do.
And you cannot convert a soft pull into a hard pull.
Right. So
It's another charge.
Okay, so if I pull a soft pull today on, let's say you're my borrower, and I pull your soft pull today, then tomorrow I pull the hard pull because it looks good. Let's roll. Now, is there? I mean, one thing to change would be something if something actually changed on your
credit report.
right.
Again, it can be. It can be different, like
Okay.
I mentioned,
Okay.
because I could have done something.
Right. But if you didn't do anything, let's say everything
If
was
I didn't
froze.
do
Let's say it was
anything,
froze.
no,
you should
it would
good.
be the same.
Go. Cool. So there you go. So that's why we do the soft pull, because it allows us to see your information. We're not alerting all those fools when start blowing your phone up, because then that's better to do stuff. Blow your phone up. So cool. All right. So Ms. Tracie, if I'm a
Yes.
lender, how do I get a hold of you for credit reporting services?
916-517-8339. Tracie Panish with Partners Credit.
And do you have an email or something like that? So you
Yeah,
know?
T Panish
But
at
spell
Partners.
that. But spell Panish.
TPANISH, kind of like Spanish. T Panish at
like that.
partnerscredit.com.
Cool. See, perfect. So thank you, ma'am. I appreciate it, guys.
Anytime.
If you're a lender, give her a call. She does awesome service. She does these phenomenal things. Heavily involved in MBA and other things local for, you know, or nationwide, I could say. But she's very involved in our industry and wants to make sure we're safe and sound. So thanks, guys. Talk to you later. Bye.
Thank you.